Free yourself from financial ruin. Understand the 10 commandments of financial freedom with these 10 most important things about personal finance. Ready? Let's dive in. First on the list is budgeting. Budgeting is a fundamental skill that everyone should master, regardless of their financial situation. It helps you take control of your money, ensuring you make the most out of every cent you earn. By creating a budget, you can track your income and expenses, identify areas where you can save, and plan for future financial goals. Whether saving for a big purchase, paying off debt, or simply trying to live within your means, a budget is your roadmap to financial success. Creating a budget is the cornerstone of any solid financial plan. It starts with understanding your income and expenses. Begin by listing all your sources of income, including your salary, side hustles, and any other money you receive regularly. Next, detail your monthly expenses. This includes everything from rent or mortgage payments, utilities, groceries, transportation, and entertainment. Don't forget to account for irregular expenses such as annual insurance premiums or holiday gifts. By having a comprehensive list, you can see exactly where your money is going. One popular method is the 50-30-20 rule: 50% to needs, 30% to wants, and 20% to savings and debt repayment. This rule provides a simple framework to help you allocate your income effectively. Needs are essential expenses like housing, utilities, and groceries. Wants are non-essential items like dining out, entertainment, and hobbies. Savings and debt repayment include contributions to your emergency fund, retirement accounts, and paying down any outstanding debts. By separating your expenses into these categories, you can ensure that you are not overspending in one area at the expense of another. This balance is crucial for maintaining financial stability and achieving your long-term goals. For example, if you find that you are spending too much on wants, you can make adjustments to redirect some of that money towards savings or debt repayment. Start by listing all your sources of income. This step is essential because it gives you a clear picture of how much money you have coming in each month. Be sure to include all sources, no matter how small. This could be your regular paycheck, freelance work, rental income, or any other money you receive. Then, detail your monthly expenses. This includes fixed expenses like rent or mortgage payments, utilities and insurance, as well as variable expenses like groceries, transportation, and entertainment. Don't forget to include savings and debt repayment as part of your expenses. By having a detailed list, you can see where your money is going and identify areas where you can cut back if needed. The goal is to have a clear picture of your financial situation. This clarity allows you to make informed decisions about your money. It helps you identify areas where you can save, prioritize your spending, and plan for future financial goals. Whether you're trying to pay off debt, save for a big purchase, or simply live within your means, having a clear understanding of your finances is crucial. Budgeting also allows you to set financial goals. These goals can be short-term, like saving for a vacation, or long-term, like buying a house or retiring comfortably. By setting specific, measurable goals, you can create a plan to achieve them. This might involve cutting back on non-essential expenses, increasing your income, or finding ways to save more money, and make informed choices that align with your priorities. When you have a budget, you can see how your spending aligns with your values and goals. This makes it easier to make decisions about where to spend your money. For example, if you value travel, you might choose to cut back on dining out, so you can save more for your next trip. Review and adjust it regularly to reflect changes in your income or expenses. Life is constantly changing, and your budget should reflect that. If you get a raise, start a new job, or have a significant change in your expenses, update your budget accordingly. Regularly reviewing your budget helps you stay on track and ensures that you are making the most of your money. Next on our list is the importance of an emergency fund. Aim to save 3 to 6 months' worth of living expenses. Keep this money in a separate, easily accessible account. This way, you won't have to rely on credit cards or loans for unexpected expenses. To build your fund faster, consider cutting back on non-essential expenses or finding ways to increase your income. Start small, be consistent, and make it a priority. Now let's talk about managing debt effectively. Managing debt can be daunting, but with the right strategies, you can take control of your financial future. Understand that not all debt is created equal, and different types require different approaches. By being proactive and informed, you can reduce your debt and improve your financial health. One effective strategy is the avalanche method, prioritizing your debts by interest rate and focusing on paying off the highest interest debt first. This can save you money in the long run because you'll pay less in interest. Start by listing all your debts and their interest rates. Make minimum payments on all your debts except the one with the highest interest rate. Put any extra money towards paying off that high-interest debt. Once it's paid off, move on to the next highest interest rate debt. Another popular method is the snowball approach, where you pay off the smallest debts first to build momentum. This can be particularly motivating because you see progress quickly. List all your debts from smallest to largest. Make minimum payments on all your debts except the smallest one. Put any extra money towards paying off that smallest debt. Once it's paid off, move on to the next smallest debt. The sense of accomplishment from paying off debts can keep you motivated. Consider consolidating your debts if you have multiple high-interest loans. Debt consolidation involves combining all your debts into a single loan with a lower interest rate. This can simplify your payments and potentially save you money on interest. However, do your research and understand the terms of the consolidation loan. Speak with a financial advisor to determine if this is the right option for you. Avoid new debt by living within your means and resisting impulsive purchases. Create a budget and stick to it. Track your spending and identify areas where you can cut back. Consider using cash or a debit card instead of credit cards to avoid accumulating more debt. Set financial goals and remind yourself of them regularly to stay motivated. By taking these steps, you can regain control of your financial situation and work towards a debt-free future. Remember, managing debt is a journey and it requires patience and persistence. Celebrate your progress and stay focused on your long-term financial goals. With dedication and the right strategies, you can achieve financial freedom and peace of mind. Chapter 4. Boost your credit score. Your credit score affects borrowing money, renting an apartment, and even getting a job. The two most important factors are payment history and credit utilization ratio. Paying bills on time is crucial, and aim to keep your credit utilization ratio below 30%. Regularly check your credit report for errors and dispute inaccuracies. By following these steps, you can improve your credit worthiness and enjoy the benefits of a higher credit score. Chapter 6. Start saving for retirement now. The power of compound interest means that the sooner you start, the more your money will grow over time. Compound interest works by earning interest on both the initial principal and the accumulated interest from previous periods. This can lead to exponential growth of your savings. For example, if you start saving in your 20s, even small contributions can grow significantly by the time you retire. The key is to start early and be consistent. One of the best ways to save for retirement is through employer-sponsored plans like a 401k or individual retirement accounts, also known as IRAs. These accounts offer tax advantages that can help your savings grow faster. For instance, contributions to a traditional 401k are made pre-tax, which can lower your taxable income. Additionally, many employers offer matching contributions, which is essentially free money added to your retirement savings. Don't forget about Roth IRAs, which allow for tax-free withdrawals in retirement. Diversify your investments within your retirement accounts to manage risk and maximize returns. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, and real estate. This strategy can help protect your portfolio from market volatility. It's also important to periodically rebalance your portfolio to maintain your desired level of risk. Consider consulting with a financial advisor to create a diversified investment plan tailored to your goals. Regularly review and adjust your retirement savings plan to adapt to life changes. Life events such as marriage, the birth of a child, or a career change can impact your financial situation and retirement goals. By reviewing your plan annually, you can make necessary adjustments to stay on track. This might include increasing your contributions, changing your investment strategy, or updating your beneficiaries. Staying proactive ensures that your retirement plan remains aligned with your evolving needs. By doing so, you'll be well on your way to a secure and comfortable retirement. Imagine the peace of mind that comes with knowing you have a solid financial foundation for your golden years. Whether it's traveling the world, pursuing hobbies, or simply enjoying time with loved ones, a well-planned retirement allows you to live life on your terms. Start saving today, and take the necessary steps to ensure a bright and fulfilling future. Chapter 6. Investing Basics. Successful investing relies on diversification, spreading your money across different types of investments to reduce risk. A crucial principle of investing is to think long-term. Consider your risk tolerance when selecting investments. Automate your investments to stay consistent and benefit from dollar-cost averaging. By following these principles, you can build a solid strategy to achieve your financial goals. Chapter 7. Protect yourself with insurance. Insurance shields you from financial loss due to unexpected events like accidents, illnesses, or natural disasters. Health insurance is crucial, as medical expenses can be extraordinarily high. Auto insurance, mandatory in most states, protects you from financial liability in case of an accident. Homeowners or renters insurance safeguards your property and belongings. Life insurance is vital if you have dependents who rely on your income. Chapter 8. Understand taxes to save money. Take advantage of tax deductions and credits to reduce your taxable income. Contribute to tax-advantaged accounts like a 401k. Contribute to tax-advantaged accounts like an IRA. Contribute to tax-advantaged accounts like a health savings account. Keep detailed records of your income, expenses, and deductions throughout the year. Stay informed about changes in tax laws to adjust your financial strategies accordingly. By doing so, you can reduce your tax burden and keep more of your hard-earned money. Chapter 9. Set clear financial goals. Identify your short-term and long-term financial goals. Make them specific, measurable, achievable, relevant, and time-bound, or SMART. Plan to achieve each goal and review your progress regularly. Celebrate your achievements along the way. This will keep you motivated and on track to financial success.